So let's talk about some things here on Retire Colorado with Alicia and Josh Lewis. I'm Bruce Steinbrock. There are threats, and if you don't properly prepare for them, they can really take the wind out of your sails. Josh, let's talk about the possibility of higher taxes, inflation that's going. I mean, again, that decade I talked about, we didn't think about inflation ever. The latest report came out recently was 3.8%. And, the Fed has never been able to dial it down to the 2. I don't know that they ever will. But let's talk about just risks. They come from all directions. And how do you help people stay ahead of it?
Yeah, this is one of those things that I think a lot of people look at kind of risk in these sort of segmented things, like it comes in a segmented fashion, like, oh, market volatility, oh, inflation. The problem is a lot of those risks sort of coincide with one another. You look at just inflation, for example, 2022 is a great example of this, where the Fed got really kind of behind the 8 ball just in terms of CPI. So we had these dramatic rate increases. So the rates just whipsawed up. Well, as a byproduct of that, equity prices came down, bonds got just absolutely crushed. So we had kind of this twofold issue, but one sort of risks begets the other, right? So you have this one thing and everybody's worried about the one thing, but then everyone sort of underestimates all the other things that's going to happen sort of in its wake. So just remember that a lot of those things are going to intersect over a period of time. And when you look at, say, like inflation, this is a great example we sort of refer to as the carbon monoxide of your portfolio, because it's just silently increasing, right? And just like carbon monoxide, if you don't ever address it, then all of a sudden you're going to have a problem, and it's going to be rather urgent. So when you look at this idea of, average inflation rate in the US has been about 3.25% since they've tracked it since 1913. So I always thought it was a little odd that the Fed had sort of this unattainable goal of like, we want to keep it at 2%. And I'm like, well, long term, you guys have never done that. Sort of like balancing the budget, right? Like, what are we doing here? Let's be pragmatic about it. And I think that's important for a lot of people to recognize is, hey, let's look at kind of this idea of our costs, basically doubling every 20 years. So we can actually, kind of keep up with the rates. And I know if you guys go out anywhere in the world, you're definitely feeling those effects. And that's going to be an issue because as inflation goes up, guess what we have to do? We have to increase the amount of yield we pay on our treasuries, the U.S. government, so that other investors buy those bonds. Well, guess what? Taxes are going to become a part of that equation as well, because we're spending more than what our GDP is by, 20 to 30% in a given year. So we're dramatically overspending the output of goods and services here in the U.S., which then sort of begs the question of how are we going to pay for that? Well, the majority of the revenue for the government comes from income taxes and payroll taxes. So that's you and I paying taxes. So then we look at that also and say, okay, that sort of leads to a great likelihood that tax rates are going to increase so that we still remain solvent on all of our debt. So I could talk in circles about this stuff, but it's this whole idea.
Very passionate about it.
One thing is going to lead to the other, which is going to lead to the other. And more often than not, it's us as taxpayers holding the bag when that all comes around.
Yeah, the two levers Congress has, reduce spending, increase taxes. Which one's easier? I don't want to do with the less. It's,
right.
It's like we're all children again. So, Alicia, let's talk taxes, which I know you're passionate about as well. Our national debt, as Josh said, is, astronomical. I mean, 41 trillion. I haven't looked at the calculator lately. It's still just nauseating to see those zeros pass by. But how do you ultimately address, the debt problem, the impact taxes have, and the effect on somebody's retirement?
Well, we have to talk about the reality, which is, eventually somebody's going to have to pay for it. And how that's going to happen is taxes are going to go up. And, when we look at retirees, most retirees, the bulk of their portfolios in tax deferred accounts, which means that is kind of a liability for them, right? It's going to become more expensive for them to take withdrawals out. And so really kind of tackling that is a really important piece of what we do in here, because what we want to look at is not just, oh, what's your retirement today look like, right? We're looking at, of course, today, 5 years, 10 years, 20 years down the road. And granted, nobody knows what's, the future holds, but we could sure be more efficient with how we structure some of our planning and be more tax efficient. And that's why, again, having a specific plan is crucial to how you can have a better strategy, and hopefully make that strategy beneficial for you and not for Uncle Sam, right? Mm. So again, it comes back to being really intentional and having a team behind you and kind of guiding you through that. And that's exactly what we do in here, because we see it and we see what kind of has to happen, right? Taxes are the lowest they've been and probably will ever be again in your lifetime, in our lifetime. And so that's where we say, okay, let's get busy while taxes are on sale and make some good decisions and good strategies so that we can all benefit from that.
Yeah, folks, think of rowing a boat. Do you want to row across a giant lake by yourself, or do you want to have other oars in the waters helping you propel yourself across that water? Well, I don't know anybody that wants to row all by themselves. So put the Lehman Lewis team to work with you. Get their oars in the water with you, rowing with you, so you move to your destination, which is retirement. Reach out to the Lehman Lewis team, 970-446-1234, right here in Loveland, Greeley, Metro, Denver, 970-446-1234. This is Retire Colorado with Alicia and Josh Lewis. I'm Bruce Steinbrock. Josh, what steps do we take so that we can really, prepare now for future? I mean, I think some people have vision problems of that. I think, I think even when we were in college, it was, write the report what you think is going to happen in the next 10 years. Nobody knows, but you still have to have a vision, right? So how do you help people cast a vision?
Yeah, this is a great question. And I think it's kind of one of those paint by the numbers scenario, right? And I love that analogy because it really is, it's a mathematically driven sort of proposition, right? Where we want to look at and say, okay, let's look at how much money you got in your IRA. And then we look at your spending habits and we look at when your RMD age is, are you in the 73 camp, you in the 75? How long until you get sort of forced into taking those distributions? And then we want to look at how you're going to spend those assets down and then look at, hey, what does that future tax liability look like? Because a lot of times families come in and, markets have been pretty darn good for, quite a long period of time. So it's not uncommon for somebody to come in with maybe $1 million, $2 million, $3 million in an IRA account. And we start looking at, hey, with Social Security, with, maybe your spouse's income, you hit this RMD age, your, MAGI, your income that you're going to be required to take is $100,000 plus all of these other things. Well, if you're not spending that, that's what we call forced RMDs. So it's above and beyond what you necessarily need for your expenses. So we want to look at that. And then we want to apply and say, okay, how much do we reasonably feel like we could afford to convert maybe to a Roth IRA? How much money do we have in maybe a taxable account? Do we have money in Roths already? Because a lot of times, and this is common with most Americans, right? Our second single largest asset besides our house is going to be our tax deferred accounts, like our employer plans. So we really want to look at, okay, do we have other dollars available so that when tax rates do start increasing, are we going to be able to blend our withdrawal rate and take some money from multiple accounts to help keep our tax liability low? So there's a lot of things that we want to look at to say, hey, how are we going to create this tax efficient withdrawal strategy, not only this year and next year, but maybe 5, 10, 15 years down the road? And sometimes it means, hey, we're going to have a very tax inefficient strategy for the next 3 or 5 years because we want to live the next 25 years after that in a very tax efficient strategy. So sometimes it is about being aggressive in those conversions. Sometimes it's about shifting where we're saving and investing. And sometimes it's a combination of the two. But really analyzing what that future tax liability is going to look like is kind of step one in that process.
Yeah, and Alicia, as you think about this, one of the big concerns, well, probably the number one concern, anybody who's listening to us today, maybe you're watching on YouTube or Facebook, because we do stream these as we record the show each week, the fear of running out of money and not knowing how long do I have to make this last? And then tax efficiency comes into there, and we have healthcare and all the different things. How do you help people determine how they can preserve that nest egg and last until they're 90, 95 or beyond?
Well, it's a plan. I mean, that is exactly what we do. We create a plan with people, and we really look at 5 areas. We want to make sure that people have an investment plan, an income plan, a tax plan, a healthcare plan, a legacy plan. But all of that sounds good, right? Like, get that in place. But how we do that is really getting to know you, getting to know what it is. What is your heartbeat of your life? What do you want your retirement to look like? And that's when we build the plan, is around that. And I think ultimately all these concerns that people have, it really does. I mean, whether you have $500,000 or $25 million, literally everybody has the same concern. I mean, literally, am I going to be okay? I'm telling it doesn't matter how much money you have. It's the same question. Are we going to be okay? And if you're having that question, what that does is it tells me that you don't have a plan, because when you have a plan, you see the numbers and you can have those conversations of, am I okay in this scenario? Well, yes, let's talk through that. The math has to math. Right. And the numbers have to work. And so that's where we put those things in front of you and show you all of the things, right? All of the income, the investments, the tax strategies, the healthcare planning. What happens when you're gone? Is your spouse okay? And what happens when both of you are gone? How is this money going to be passed on? And is that the heartbeat of your why? Is that really matching what you want? And so kind of back to your question, Bruce, the question of, are we going to be okay?
Mm-hmm.
When you have a plan, you can see that. And even when sometimes people get a little weary and say, are we still going to be okay? That's what we're here for, is to walk through that and continue to make those adjustments, because life changes, economy changes, taxes change, all those things change, and your plan is flexible, right? And it needs to be guided with that. And, but to have a sounding board, to have a team of advisors to be able to sit down with you and say, it's okay. We've planned for this. Of course, we've already thought of that. And here's how we navigate that. So it is crucial to have a plan. I can't stress that enough. We talk about that all the time.
970-446-1234 for the Lehman Lewis Financial Team right here in Loveland, Greeley, Metro Denver. 970-446-1234. More Retire Colorado with Alicia and Josh straight ahead.